The RBI's monetary policy has suddenly become very important and interesting, with the second quarter GDP growth disappointing hugely. The policy announcement is on Friday, December 6, and as always, the CNBC-TV18 Citizens Monetary Policy Committee meets to deliberate on the issues before the RBI and its MPC and what they may do. Let me welcome Chairman of our Citizens MPC, Dr. Pranab Sen, and members Sajid Chinoy, Shaumyakanti Ghosh, Samiran Chakrabarti, and Sonal. Sonal and gentlemen, thank you very much for your time. Let me start straight away with what action is expected, because we can look at the background of growth and inflation in a bit. But first, Sajid, let me start with you. Do you think now it calls for a cut, irrespective of the fact that inflation is high?
Lata, we've always been in the camp that there'd be a cut in February. So it was not this meeting, but the next meeting. And I think what you've seen is this delicate trade-off where public investment and government spending was doing a lot of the heavy lifting in the last couple of years. And the first signs that public investment has stepped back in the first 6 months of this year, kind of softer private demand has shone through. And that we had kind of worried about and known about. The complication for the RBI is that the economy in the last 2-3 years has been hit by a series of supply shocks. Right? Food supply shocks. And so, average CPI has been 5.8% for the last 4 years. This year it's come off, it's still been 5%.
Yes.
And so that's been the difficult trade-off, that we understand the government's doing the heavy lifting. We understand private sector demand hasn't picked up where it is. But when you've got sustained, repeated supply shocks and high food inflation, the worry is at some point this will spill over. Our sense is this increases the conviction that a February cut happens. I think in December, the central bank, the MPC, sets the stage for a February cut, pivots more dovishly, and more importantly, sets the stage for liquidity management. Because without the liquidity management from December onwards, any cut in February will not transmit into financial markets. So The way I see this is you use this meeting to inject liquidity, pivot, and then ease in February.
No, I think that is an important point that the Reserve Bank will think of. There is also the credibility issue, but I'll take the liquidity argument. Samiran, is there a case for a CRR cut, therefore, since, liquidity, in a way, is going to be challenged even in the days to come? Look at the way the dollar is strengthening and the rupee is declining.
So, Lata, if you just look at the liquidity numbers, the durable liquidity is corrected by almost 2 trillion rupees in just about a month because of mostly the FX sales and the festive season currency in demand. So, one can make a case for some liquidity easing, and not to forget that in the last 10 days or so, the market-based overnight rates are now running about 20 basis points higher than where the repo rate is. In the last few months, it has just been reverse, where it was lower than the repo rate. Now, obviously, we can decide on what instrument is the best instrument to give this liquidity. CRR is a relatively easy one, particularly if you think that pre-COVID CRR was 4%, and that's probably the only variable which has not yet gone back to the pre-COVID levels. There might be some justification for considering a CRR as well. But overall, I think at this time, I will agree with Sajid that some liquidity easing could be the first step towards a broader monetary policy easing through rates.
Okay, well, I'm going to ask the same question to actually all the members. Shaumya, to you as well. You have to rekindle animal spirits. You have to give some confidence as well. So can the Reserve Bank stay away from both a repo and a CRR? Some obvious symbolic action may be needed?
I think I take the point that some sort of a liquidity adjustment is to be done in this policy, because the simple reason is the food inflation is still running close to double digits, and headline inflation was running over 6%, and it doesn't seem to be coming off the cliff very quickly. But the point over here is that there has to be a very delicate balance of liquidity, because if you look into the liquidity management in the last couple of months, what has been happening is that the government cash balances have become the elephant in the room. From a positive number, then to WMA, then again to negative. So it has been fluctuating significantly in the last 2 to 3 months. And we need to remember that a large part of this government cash balances is basically frictional liquidity. So suppose if there are any liquidity injections or management the Reserve Bank wants to do, it has to match that frictional liquidity with frictional liquidity injection itself instead of permanent liquidity injection.
This is what they're doing with the variable rate repo.
So from that point of view, I think while the liquidity management has to be done, but there needs to be a debate on how this need to be balanced with an permanent liquidity injection vis-a-vis and frictional liquidity adjustment. But there is also another point is that because of the significant rupee liquidity suck out, because of the intervention to support
because of the dollar
rupee,
sales,
that is also adding to the problem of the central bank.
Absolutely.
So
I mean, that's my point, So even if you look at CRR as a more permanent instrument, it looks like this dollar issue is going to be with us. So maybe there is an argument there. Sonal, what do you think?
Lada, our view is we are already late. Monetary policy works with lag of 3 to 4 quarters. The slowdown has been ongoing for 6 months now. So we think it's basically high time to reverse the cycle. If you just go back to what the monetary policy framework is, it is to target inflation 4% plus minus 2%, while keeping in mind the objective of growth. And what has become very clear is that growth is already below trend, and there is no countercyclical response that's coming through even now. And therefore, I think the expectations that growth will somehow go back to 6.5–7% without a countercyclical response looks extremely unlikely. I think the outlook, the entire debate, therefore, is in terms of how much trade-off there is at this stage. Now, monetary policy has to be forward-looking. The one-year forward inflation forecast is very much aligned close to the midpoint. The second round effects have not actually materialized. And the effects, some sort of a nominal adjustment on the effects is warranted as a counter-cyclical tool as well. And we have FX reserves. So I think the argument that, the trade-offs are significant because inflation is high or because currency is weak actually does not hold water. And the balance of risk, in my view, definitely calls for supporting growth at this stage because without growth, there are multiple other macro issues that we'll have to deal with. So I think it's time to support growth both via a repo rate cut as well as via a CRR cut, because even the transmission from banking system is going to take time. I mean, banks have been busy collecting high cost deposits. So even if the RBI sort of cuts the CRR now, the entire transmission to the lending rates is going to take time. So we need to act now.
No, I take your point that it takes time to act. But the counterpoint is also that why is consumption weak? Because of inflation, isn't it? Any one you speak to on the street tells you that onion still selling at 90 rupees a kilo. So Dr. said, your best place to put where the policymakers hat. Can the Reserve Bank do a cut without injuring its credibility as well when the last number is above their mandate? It is 6.2, the October number.
Well, it depends on what you're talking about. I mean, if you're talking about the repo rate, I don't think there's much of a case. The really interesting question is what you do with liquidity management. There seems, one of the standard tenets of economics is that if you are getting inflationary impulses coming from areas over which monetary policy has very little control, and in this case it is food mostly, your main focus should be to prevent it from spilling over into the core. And for that, interest rate management is not the appropriate tool. It is liquidity management. Now, the question is, so I've got a situation where food inflation is nearly double digits, but I've got a GDP growth rate which is significantly below par, 5.4. And so you are getting the liquidity management demands are working on two sides. That is, if you actually open up on liquidity, you run the risk of the non-core spilling onto the core. If, on the other hand, you are too tight with liquidity, then your growth revival may not happen. And Sonal is right, we are running below trend. But I think one has to be a little careful with these growth numbers, because there is a very strong base effect which is playing out, and it will play out in the next quarter as well. It's only in the quarter after that should we expect to see any normalization happening. And we should be very careful about this. The big question out here is that when you're talking about liquidity, do you create a situation where the increase in liquidity is because the banking sector demands liquidity? Or do you create it through an instrument where the liquidity is given to the banks regardless of whether they want it or not?
Okay.
Now, that makes a lot of difference. So in a situation like this, I think the CRR cut is not a particularly good idea. One should focus a little bit more on what do we do with the variable repo.
Okay. Fair point, sir. There is going to be a lot of debate on this within the Reserve Bank MPC itself. Though CRR is not an MPC instrument, it will be a RBI decision. But in our case, our MPC is going to vote on both. Let me take the vote first. The first question I'm going to ask my panel is, what will the Reserve Bank do to interest rates on December 6th? Sajid,
we have a cut in February, so a hold in December.
Hold. Okay. Nothing, no action. Samiran? Soumya?
We are hold.
Okay, hold.
Very similar to Sajid, the hold now and cut in
Okay,
February.
none of you want a cut. Sonal?
25 basis point repo rate cut.
Okay, there you are. We have the first cut. And Dr. Sen?
Hold.
Hold. Okay, so this is 4:1 in favor of holding. Let me take the CRR question. Your thoughts, your vote.
Some liquidity management for sure, not necessarily CRR, but some liquidity management.
I'm taking a no for CRR.
But some liquidity.
Okay.
Yeah.
Soumya?
I would paraphrase it saying that CRR should be used as a counter-cyclical tool.
No or yes?
Some, not headline CRR, but yes on some specific products.
Okay. Yes, I'm going with a yes for Soumya. Shamiran?
I think it is likely, it's possible to do.
Okay, I'll take it as likely then, which is more a yes than a no. Sonal?
Yes, CRR cut.
Okay. Dr. Sen?
No.
No. Okay,
Categorical.
so categorical no. Okay, then I'll take it as 2 no's and 3 yeses. So probably more of a chance of a CRR cut. And very quickly now, last vote. When do you see the first rate cut?
February.
Soumya?
February of a larger magnitude possible.
Okay, February 50 bips. Okay, Samiran?
February.
But I think we already have Sonal's vote, right? Sonal is December. So I'm not asking you, Sonal. You can flash December. Dr. Sen?
February.
Okay, so just about everyone is expecting a February cut, except Sonal, who thinks that it should be advanced. But what are the arguments about growth itself? Is it as bad as 5.4? As Dr. Sen says, it is just the base effect. How do we see food inflation panning out? All those questions after the break.